Greetings, my name is Kevin Matthews and I would like to welcome you back to the Tax Academy, where class is always in session because the learning never stops. And today we're going to talk about temporary job assignments while you're away from home. And so here at Beta Solutions, one of the things that we really focus on is the international tax area. We do taxes of all kinds, but international is kind of sort of our niche. And when we talk about the international realm, basically there's certain time gates that we have to be cognizant of because it all depends upon country. Sometimes there's tax treaties involved. Sometimes there's also other types of treaties that can actually affect whether a time gate becomes very important. And so, like in some countries, it's 30 days. Sometimes it's 60 days. Sometimes it's 90 days, 180 days, a year, 2 years, 3 years are very common time gates that we sometimes have to work with. Domestically, it's actually much simpler than that. We only have to worry about the 1 year mark. Okay, so if you take a look at it from this perspective, and you're going to be away from home temporarily in order to go do something, basically what ends up happening is that there's certain deductions that you're allowed to take. Now today we're going to focus on the temporary assignment that you leave on, and the definition of temporary under the IRS rules is 1 year or less. Now before we get into some of the rules that you're going to be able to do, let's talk about this 1 year or less rule. It is an expectation, not necessarily what actually happens. Okay, and some people kind of go, why would they do that? And part of the reason why is because, and look, there's a lot of things that happen in the tax code that I think is kind of crazy. This actually kind of makes sense if you kind of see from the big perspective of things. So, for example, if I work for myself, but say I was back working at the accounting firm, and they came to me and they said, look, you're an international guy. We have a client who needs an on-site international person. We're going to send you to go work on the client site for the next 18 months. And it's going to be a temporary assignment. However, you're going to be gone for 18 months or longer. There's certain things that are not deductible when I go longer than a year. And so there's going to be certain deductions and certain ways of recording things that I'm going to do on the expectation that my assignment is not going to last, more than, it's not going to last less than a year. Now, here's the thing. Obviously, during the assignment, that could change. I could go work with the client, and say, for example, they come into me all of a sudden one day and they said, hey, the operation that we had that, maybe there's a war that goes on in that country, or maybe there's a terrorist incident or something of that nature, and all of a sudden the operations they have to cease. Maybe they don't need me anymore. And so they said, hey, instead of working here for 18 months, you've been here 9 months, we're going to send you back home tomorrow. Okay? They could do that. And technically the way the IRS is going to look at it is it's still going to be considered a long-term assignment because reasonable expectations were that it was going to last 18 months. You could have the opposite that happens. You're going to go from point A to point B, and you said maybe instead of 18 months it was only expected to last 9 months. So as I'm going through the whole thing, and there's certain deductions, and we'll talk about a lot of those deductions we get to do here. I'm taking all those deductions, writing all those, and it's entirely possible. What if this assignment starts in November and then it bleeds over into the following year? Well, in the current year, from November to December, I'm writing this off as though it's a short-term assignment. Maybe they come back to me after 6 months. They say, Kevin, you're great. We really like you. We know this was supposed to be a 9-month assignment, but we're going to go ahead and extend this to 3 years. Once that is put out there and accepted, my short-term assignment is no longer short-term. From that day forward, I am now under the long-term assignment rules. So you can understand that it's the intent that sort of kind of keeps up with this. And I know with most things with the IRS and with taxes and things of that nature, intent really doesn't matter as much as I would say, actual facts and circumstances. In this case, intent is a huge factor. And so you want to make sure that you've got your ducks in a row, and we'll talk about some of the stuff there. Now, Before we also get into some of the expenses that the expenses that we're going to be able to write off and things of that nature, there's something we need to address, and that's the Tax Cuts and Jobs Act of 2017. Sometimes it's called the Trump tax plan. Basically, what happened is that when they did the whole change under the Tax Cuts and Jobs Act, one of the things that went away was unreimbursed employee expenses subject to the 2% limits. And you know, I know that sounds like a fancy term, but basically what that means is, if, you know, I'm working for my company and they send me on an assignment to go somewhere and they say, Kevin, we need you to drive there. You're gonna, you know, you'll be responsible for your food for the day that you're there. And then you come back and you're like, yeah, and the company says, yeah, we can't really pay for it because for various circumstances, it's just not something that we're going to reimburse you for. You could, under the old law, take all of those expenses you had, put them on your tax return, and then you could write them off. And the whole subject of 2% was they would take your entire adjusted gross income, which is the bottom of the front page of the 1040. Now it's modified a little bit, but it would be the adjusted gross income, which would be at the bottom of the tax return, and they would just take that, multiply by 2%, and you'd only get to deduct things over that 2% limit. So what it prevented is that people weren't able to take tax deductions on, you know, $200 here, $200 there, whatever. It's got to be a significant amount of money before they're going to let you start taking those deductions. Well, under the Tax Cuts and Jobs Act, 2% deduction limits went away. So what ended up happening is that a lot of these unreimbursed business expenses went away. So something that we're actually talking about with our clients, and something that I know that the industry, a lot of CPAs are recommending to their clients, they're actually recommending that you set up what's called an accountable plan. And what the accountable plan basically is that, hey, if you have expenses that you incur as a result of doing work for us, you get us the receipts, you get us all the documentation that needs to be done with it, and we're going to cut you a check to reimburse you for those expenses. That way, what ends up happening is you're made whole again, because, you know, if you spend $100 on a business trip and the company gives you that $100 back, everybody's happy. The company then gets to be able to take that as a tax write-off because it's considered a business expense. And so what's happened is that there are a lot of really small companies that basically said, we don't have enough resources to set up these accountable plans. We don't have the resources to set up a lot of the things that are necessary in order to be able to do this. You can just write off on your taxes. There should be no problem. And in the past, that it wasn't a problem. Now it's becoming a problem because all of a sudden now, you know, from 2018 on, you know, clients are, I mean, you know, taxpayers are basically, you know, being asked to foot a bill that they're not going to get reimbursed for. Now, something to also understand about this with the Tax Cuts and Jobs Act, the Tax Cuts and Jobs Act removed miscellaneous itemized deductions for a period of time. It actually goes from 2018 to 2025. Okay, so that's when it's all suspended. Now, supposedly in 2026, they're going to be unsuspended. I have a feeling that when they begin to realize the costs of doing that, I have a feeling Congress isn't going to let these things be reinstated. I think they're going to go away, and I would plan for that. So I'm not going to really get into the, hey, in 2026, this is what you can do. Let's be honest, it's 2019. In 2019, you probably are not really that concerned about what's going to happen in 2026, unless you're talking about retirements and things of that nature. And especially with Congress, I mean, all of a sudden we get a new president in who has different priorities, different objectives, and maybe they're going to revamp the entire tax code, and there's nothing really to worry about on this. I'm not talking too much about it in this video any more than that, just because God knows what's going to happen in 6 years. Okay, so I say we just wait until later. Now, during the assignment, the different types of expenses that are allowed, you're allowed to deduct personal living costs you incur while on temporary assignment away from home. Lodging and meals will be deductible, but only if they aren't extravagant or lavish. which basically means no, you cannot eat Red Lobster every day and have a lobster and steak for dinner and be able to deduct it. Now, obviously that's an example of lavish. Now, I mean, here in the Washington, D.C. metro area, sometimes a dinner can run about $20, $30. I know when I was in the Midwest last time I was at a Red Lobster, steak and lobster actually wasn't that expensive. But when they talk about extravagant and lavish, we're talking like, there's some restaurants that are here in the Washington, D.C. area. You want a good steak dinner, it could cost you, $50-$60 per person. That would be considered expensive and lavish. And it's also going to depend on territory that you go to. If you take a business trip to New York, extravagant and lavish costs are going to be much different than if you take a business trip to Ann Arbor, Michigan. It's just because the cost of living is vastly different in both locations. It's going to be a fact and circumstances case. And if you have any questions about it, you need to talk to your CPA, or you can leave a comment in the comment box below, and I'll be happy to address it. Meals are subject to the regular rules, which allow for half the cost deductible. In other words, it's a 50% deduction on this. Other incidental living expenses such as laundry or dry cleaning will also be deductible. So if because you're in this hotel, and say you're in a hotel for 6 months, you don't have access, unless it's one of those long-term stay hotels that's just very highly equipped, you're probably not going to have access to a laundry facility unless you go to a laundromat, or unless you have to pay somebody in order to do it. Again, you can't be lavish about this. So you want to make sure that things are taken care of in that sense. You'll be able to deduct the cost of trips to home on weekends, but only up to the amount you would have spent for lodging and meals at your temporary work location had you not gone home. So if you say, hey, look, I'm going to go, say instead of Washington, D.C. to California, maybe it's from Washington, D.C. to Memphis. Coming home on the weekend's not an unrealistic thing, especially, I'm a pilot, so, flying home from Memphis is actually not that hard. It's a few hours from here, depending on what kind of an airplane you've got. But basically, here's the thing, is that if I were to stay in a hotel that's, $100 a night, and my food, say, for example, is $70 a day, I could deduct expenses of coming home up to $170 a day times 2, for that $340. So it's something that you need to kind of navigate around with the rules and be careful about this. Usually what happens on these long-term assignments, in an industry that we tend to see a lot of these temporary assignments, is the consulting industry. And it's just because, client, maybe you work for one of these big consulting firms, and they say, hey, we got a client over in Los Angeles, and then the next week you're going to be going to Philadelphia or whatever. And part of the deal that goes on with the consulting is that they get a thing where the company is going to reimburse to send the consultant home for a week. If we're talking like, say, for example, you've got a 9-month assignment, they say, well, the person can go home for 1 week during the assignment at date X, and that'll be arranged up in advance, and then they can fly home. And then the company's going to pick it up. So the deductions on that's going to be limited to how much you would have had to if had you stayed in the hotel the whole time and eaten the food. Okay. Let's see. So the next thing, so the miscellaneous itemized, you cannot deduct them on your personal tax returns. You need to go to your company and say, hey, look, you want me to do all this stuff and you want me to pay for it. That's all fine and dandy. I don't get a tax write-off anymore. So there's absolutely no benefit. My personal opinion, it probably wasn't that much beneficial to begin with. You probably should have been on an accountable plan anyways, but that's something that you probably need to be examining with your employer. And to be straight and honest, this is part of your employee compensation negotiation. You should be talking to them saying, hey, look, you're asking me to do all these travel, you're not giving me a lot of money to either A, I need an increase in my salary, or B, I need an accountable plan in order to be able to make up for some of that stuff. Okay. So, again, the biggest thing that we need to worry about is it temporary or not? Okay, that's probably the biggest thing that companies need to be concerned about. And the IRS will question this, and sometimes they'll say, hey, look, prove to us that this assignment was intended to be temporary before it became long, or even worse, prove to us that it was not intended to be long-term and then became temporary. Because there's definitely a lot of funny business that can sometimes go along with this. And I think the biggest answer to solving a lot of this is documentation, and that's actually your HR department who should be doing that. And look, I'll take off my accounting hat, put on my HR hat for a few seconds. HR world should be handling all of that, as far as whether it's a temporary assignment or a permanent assignment. And we do those in the international world, where we do them with, we call them assignment letters. And if you're sending somebody on a temporary assignment, you should be giving them an assignment letter that says, this is what it is, this is what we expect, this is how expenses are going to be handled. Something that we tend to see a lot more in the larger companies, using governmental per diem rates in order to be able to reduce a lot of the documentation that needs to take place. You can use per diem rates, the same, and their government publishes them, so you might as well go ahead and use them. I think they're a pretty reasonable expectation amount. I've only, when I was in the Navy, I worked in the P3 world, and the P3 world was very famous for per diem, being a per diem area where we deployed and we always got per diem. Yeah, there are people who can take advantage of it, but I mean, what they're doing is they're really just taking money for themselves and just using it differently. And so my personal opinion, I recommend the per diem system myself, just because it's easier, and the record keeping is actually much simpler for the company as a whole. So anyways, that's all I got to say about that. Once again, my name is Kevin Matthews. I want to thank you for coming back to the Tax Academy, where class is still in session because the learning never stops. If you have any questions you want to ask me and you think the group will benefit, go ahead and leave a comment in the comment box below. If you want to ask me a question more directly, go ahead and try to contact me at my website. It's www.betasolutioncpa.com. Again, that's www.betasolutioncpa.com. And you can reach out to me and ask to talk to me. Something that I will also request, if you do like these videos, please go ahead and hit the like button. If you like the series, please go ahead and hit subscribe. We're trying to get our numbers up so that we can spread the message. Like I said, guys, I'm doing this because I really enjoy trying to chip away at the ignorance that there seems to be in the world about taxation. I wish they did a better job of teaching all of us about this in high school, but they don't. Although I hear that there's some classes that are coming back as a result of it, but we'll see how that goes. Again, thank you very much for watching this video.